What's going on, you guys? My name is Daniel, and here on this channel we talk about stock market investing. And today we're back with week 4 of the TFSA challenge. So in this challenge, just to recap, the whole goal of it is to start with $2,000, which I did in March 2021, and every single week from then on, I'm trying to deposit $200 into this account. And by the end of 3 years, the goal is to hit $50,000 in this account. Now, I'm not going to use any sort of advanced investing tricks here. All it is going to be buying and selling and holding for the next 3 years. Most of the stocks that I'm buying here are not penny stocks. A lot of them are growth stocks or dividend paying stocks. I do have a couple of stocks in the $1 range. However, they're not making up a large majority of the portfolio. Now, what I'll be covering in today's video is first breaking down the average salary of a millennial and showing how it's easy to achieve an $800 deposit into this account every single month. After that, we'll be going over the portfolio and a couple stocks that I'm looking to buy next week with my $200 deposit. And to cap off the video, I'll be answering 2 questions from the previous video. If you guys have any questions about investing at all, feel free to leave them down below and I might pick your question next video to answer live. Now, starting off, I'm going to show you guys how you can budget with the average new grad salary. And I'm assuming a new grad salary in Canada is around $45,000. After punching this number into a tax calculator for Ontario and Canada, the average take-home salary per month is $2,993. Now I'll jump over to my computer and break down how you can budget this $2,993 and actually get over $800 every single month to deposit into a TFSA investing account. So I've pulled up a spreadsheet which I titled How Anyone Can Become a Millionaire Working a Minimum Wage Job. For the minimalist budget, we have rent here, which I've averaged to around $650 per month. Depending on where you live, you may be able to get rent for cheaper, or it might be more expensive if you're in a city like Toronto. Then I have water and hydro averaged at around $80 per month. A phone bill I put at $30, which is very possible. Currently, I pay $1 at Public Mobile, and I get 1 gigabyte of data and unlimited minutes. Next, we have internet at $40. This might be a little bit hard to find. I'm paying around $66 right now for internet, but if you're okay with slower speeds or maybe a third-rate carrier, then you can get internet for $40 a month. Next, we have food at $200, and this I really should have titled as groceries. So for the average person, you can probably live on groceries of around $200 if you're not buying organic or any bougie items. Next, we have eating out. We're assuming that as a minimalist, you eat out once a month, and that meal could be $25. But you could also split this $25 into 2 more fast food meals, which might be around $12 per meal. So you can actually eat out twice with a budget of $25. Next, we have shopping because you have to replace some items. For example, you may want to buy items for your desk or for your wardrobe. So we budget around $100 for shopping each month. Then we have transportation at $150, which I believe is on average what you could get for a monthly bus pass. Lastly, we have miscellaneous. So this is miscellaneous spending. Anything that doesn't fall under these categories will be in this $150 budget. These things can include health, entertainment, or subscriptions. So the grand total each month for a minimalist budget is $1,425, or in daily terms, that's $47.50. Now, if we scroll over to the slightly more generous budget, I have rent at $750. Your water and hydro will still stay around $80 unless you love to shower for hours and hours. Your phone bill, let's say you pay $45 because you want a little bit more data. Internet, you want slightly faster speeds at $45 per month. Food, maybe you're a bigger eater and you spend $300, or maybe you can afford those organic goods. Eating out here, I have budgeted $100. Perhaps you like to go to a fancier restaurant and spend $50 on a meal, and then maybe you do 2 takeout meals during the month. Next, we have shopping at $300. So this is 3 times as much as a minimalist budget, which was at $100. Maybe you enjoy buying higher quality goods, or you're an electronics nut and you buy 1 piece of electronic equipment every single month. This $300 budget should allow you to do that. Then we have transportation for $200. Maybe you take the bus, but also you Uber around a bit here and there. So that extra $50 could get you that Uber so you don't have to stand there waiting out in the rain on those bad days. Lastly, we have $200 for miscellaneous. So this is again your health, entertainment, and subscriptions. And the grand total for the slightly more generous budget is $2,020 per year. And in day terms, this amounts to $67.33. So now that we have these two budgets of around $1,400 and $2,000, let's see what we can get in terms of savings. So for the minimalist, if your take-home pay is roughly $3,000, you save around $1,500. And after 5 years, if you were saving every single month this amount, you would have $94,000 in a bank account. This is if you didn't invest it at all and it collected zero interest. Now for the slightly more generous budget, again, your take-home pay is the same at $3,000, and you will get around $1,000 each month in savings. And after 5 years, your total amount saved is $58,380. The next thing I'm going to show you is what if you invested this amount, either for the minimalist savings or the slightly more generous budget savings, and you were to get an average of 7% return on your money. How much would you end up with after 5 years? So in this area of the spreadsheet, I've laid out how much each year's savings would be worth after 5 years. So the amount that you saved from year 1, I'm assuming that you invest all this money at the end of the year, so this is your worst case. Then it would have around 4 years to compound. It would equal to around $24,664 on the 5th year. And now year 2 has about 3 years to compound, year 3 has 2 years, year 4 has 1 year, and year 5, I'm assuming that you don't even compound this at all. So after 5 years, if you're a minimalist and you get an average return in the stock market of 7% each year, the grand total that you would have after 5 years is $108,206. So that's roughly around $14,000 more than if you didn't invest it. Now for the slightly more generous minimalist, you save around $973 a month. And after 5 years of purely savings and no interest, you would have $58,380. Now, if you were to invest it over 5 years, after 5 years, the total amount you would have is $67,146. So that's a difference of around $9,000 if you were to just put your money into a bank account earning no interest versus investing it in the stock market. But again, remember, these gains from the stock market are not guaranteed, and if you were to pull out your money during a market crash, then you would likely have less versus the case where you didn't invest at all. Now looking at these two budgets, and if you were to invest the money versus not investing it, all 4 of these numbers could easily get you a down payment for an apartment or even a house. So breaking that down, I hope that you guys can have a better understanding of how to budget your money in order to set aside a portion of your income to invest for the long term. Because as I showed, after 5 years, you could either save that money in cash, use it as a down payment for a house, or if you invested it and had an average return of 7% each year, then your capital would have grown even further to get you a larger down payment on your house. Now let's jump over to my portfolio review for this past week, and I'll show you guys what stocks I bought and what I'm planning to buy next week. So we're here in my TFSA account, and it's currently worth $2,680.27. I have around $99.33 available to trade. So this means I didn't spend my $200 this week, and I'll explain to you guys why a little bit later. Now looking at the activity feed, we can see this week we actually started earning some dividends. We got dividends from our VFV of 27 cents and RioCan of 56 cents. Honestly, you guys looking at this are probably laughing because this is not very much. However, over the next 3 years, I expect the dividend amounts to increase as I put more cash into both these positions. As for what I bought, we can see here I bought some Stella Jones. I bought one share at $52, as well as I bought another share at $51 here. And there was another order which I was putting in for Enbridge, 2 shares at $46. And this order ended up expiring because it was a limit order, and Enbridge did not touch $46 after I placed this order on April 5th. So that is the reason why my account currently has $100 left to invest. Now I'll be talking a little bit later on what I'm using this $100 plus another $200 that I'm going to deposit right now. So now you can see we have $299.33. Now let's jump over to the spreadsheet tracker and enter this new entry in there. So I deposited $200 and the date today is the 11th and the type is a deposit, so we're going to submit that. And as the script runs, we can pop over to the Wealthsimple Transactions tab. You can see right here that I have a cash deposit of $200. Now, if you guys have been watching my videos previously, you'll notice there's another column here. This is number of TSX units. Now, the reason for putting this column here is to track my performance against a TSX ETF. So every time that I buy a stock or my starting positions, I'm going to take the total amount which I put into a specific stock position and figure out how many units of a TSX ETF I could have bought instead. And the ETF that I'm using is actually called XIC, which I've logged right here. So this is what I'm basing my portfolio against right now. So you can see here with this Air Canada initial starting position, if I put $86.40, I would have got 2.86 units of this TSX ETF. And the number of units is actually based on the purchase date, and we're taking the lowest price of the TSX ETF on that day. So this is actually going to make the challenge a little bit harder. Now, if we jump over to the portfolio metrics, we can see here that I'm actually tracking the current value of my portfolio if I were to have bought into the TSX index fund. And that is $2,900.22. And my portfolio versus the index is actually down by about 0.7%. And the total value right now is around $2,880.27 after that $200 deposit. I'm also tracking here the TSX 1 week change, and this is not the ETF, this is actually the index itself. And further down below, we can see the TSX change since March 16th is around 1.34%. Here we can see the percentage change in my portfolio, which is the total value versus the book value. So I'm up around 1.39% in total on this portfolio since March 16th. Now jumping over to the total portfolio sheet, we can see that Kinaxis is still the number one position in my portfolio. Now if we were to sort this by the 1 week performance, we can see that the stock with the highest performance is Good Nature Products, and it's up around 10% this week. The next position that rose the most is Ryokan at around 3.59%. And the stock that dropped the most in 1 week was actually Stella Jones, which is the stock that I just started buying. So likely for this coming week, I'll probably buy another share of Stella Jones. Then I'll look to buy shares of Enbridge at around $46 per share. Again, if those orders don't go through, then I'll keep waiting. Now sorting this portfolio back to market value, if I have an extra $100 to spare, I'll probably look into adding another share of VFV. Now, if I don't have enough money left over for VFV, then I'll probably add the leftover money into TELUS Corp. The reason why I'm adding into TELUS Corp is because TELUS is still down from the time that it announced it was doing a capital raise of around $1.4 billion. TELUS pays out a dividend of around 4.97%, and currently I have yearly income from TELUS of around $8.98. So I want to continue boosting this because it's got a fairly high dividend yield, it's relatively safe, and TELUS is also doing a lot of work outside the telecom space. So this is why I would be adding more to TELUS if I can't afford a share of VFV. Now we're going to answer 2 questions from last week's video. So the first question comes from Hot Small Town. And the question is there a reason you are so spread thin, almost too diversified, and really heavy on the higher risk securities? So to answer the first part of this question, the reason why I'm spread so thin is because I started out with a small amount of money of $2,000, and I wanted to build this portfolio to around anywhere from 10 to 20 positions. And the reason for building it out into those many positions is because I am planning to grow this portfolio eventually to $50,000. So once this portfolio reaches around $50,000, each position won't look as thin. The strategy that I'm using for this portfolio is the dollar cost average method. So that's why I'm spreading myself so thin so I can dollar cost average into these different positions over the next 3 years. Also, you mentioned that a lot of the securities I'm buying are high risk, and I would kind of debate against that, and I would say they're not high risk. Right here in this portfolio risk chart that I have around 32.5% in medium risk, 23.1% in high risk, and 44.4% in low risk. So I would say this is more of a balanced portfolio. Then again, this is actually my own assessment of the risks of these investments. If we're looking at it from a dividend stock percentage, we have 48.3% in dividends and 51.7% in non-dividend stocks. And if your definition of safe stocks are dividend versus no dividend, then again, I have about half in dividend paying stocks, so half in safe stocks and half in higher risk securities. The next question comes from Cook Shack, Christina, and then some. And the question reads, "Hi Daniel, thank you once again for all that you do, and could you possibly speak to some of us that don't have $200 a week to put into a TFSA the way you do? What would your suggestions be? Let's say a person only has $200 a month to put in. Thank you very much," from Anita. Now the answer to this question is, it really depends on your situation. If you want to put in the time and you want to be able to learn from this $200 a month deposit and beat the market, then I would suggest doing a lot of research into different stocks and trying to pick 1 or 2 stocks that you have high convictions on to be able to grow your money faster than the market moves. Now, for the person who doesn't want to spend that much time, maybe you just want to spend 20 to 30 minutes each month on investing, then my suggestion would be to put it into an index fund, or maybe splitting it amongst a couple index funds. The best index fund that I recommend right now is the one that I have in my portfolio, and that's VFV. This tracks the S&P 500 index. Investing in the S&P 500 ETF is probably better than investing in the TSX. And the reason why I say this is because this S&P 500 has more technology weighting into it. And personally, I'm a technology bull. So for that reason, I would prefer to invest in the S&P 500 versus the TSX. And that's why I don't have a TSX ETF in this portfolio. So that about wraps it up for this episode. If you guys have any questions and want me to answer them on the next video, remember to leave them down below in the comment section. As always, leave a like down below if this video was useful to you, subscribe and hit that notification bell if you want to see my TFSA updates, which come out every single Monday. I've got 2 videos on the screen up here. If you want to check them out, I'll see you there. If not, keep up the grind and have a great day.